But on to my topic, which is life insurance, and I'm putting this chart up here because I think this really is what I'm going to focus on today. This is the insurance assets as a percentage of total financial assets going back to 1880 to today. And looking at this chart, you certainly know there's a great story to be told, and indeed there is, and I'm going to very, very briefly tell it. Canadian life insurance companies started out post-Confederation competing against large foreign-owned entities. The federal government, by legislation in the 1870s, required all non-Canadian insurance companies to deposit with the government sufficient securities to satisfy their liabilities. This caused many of these foreign competitors to leave Canada in protest, which left the market open to domestic life insurance companies to take significant market share from them. This allowed the life insurance industry at that time to take on its leading role in the Canadian capital markets. Unlike the banks, they held a broad portfolio of invested assets, including corporate bonds and stocks, mortgage loans, collateral loans, real estate, and government bonds. They issued their own loans to policyholders and lent to call brokers in the early securities industry, and underwrote debentures and stock issues and invested in banks and industrial stocks. Indeed, they were the first financial firms to participate in fixed capital formation in Canada. The extent of this participation is reflected, for example, in their loan growth in the Canadian utility industry at the turn of the century. Legislation at this time permitted life insurance companies to invest in this booming industry. And as one example, 3 life insurance companies owned all of the bonded investment of the Toronto Electric Light Company, which itself had a monopoly in the city of Toronto, and the same is true in Montreal. The story could be told there. However, Canadian life insurance companies and banks were not wholly separate financial institutions at this time, but rather they were interlinked through ownership ties and dual membership in their boards of directors. These relationships were driven principally by the chartered banks' need for short-term funding to finance their short-term loans, which was their principal business at the time, and the life insurance industry provided a source for that short-term funding. This relationship was established very early on and would remain in existence for quite some time to come. Specifically, the Bank of Montreal and Sun Life Company were interlinked, Canadian Bank of Commerce and Canada Life, Toronto Bank and the Manufacturers Life, and Molson's Bank and the London Life Insurance Company. Politicians were the principal directors of life insurance companies at the turn of the century, and given the dominant participation of life insurance companies in capital allocation to these booming industries, it was a comforting thing to investors to have politicians actively involved in overseeing the operations in the absence of any government regulation, real government regulation. At the turn of the century, the life insurance industry was regulated primarily by government legislation under the Dominion Insurance Act created in 1899. The major provision of this act required insurance companies to set aside legal reserves against liabilities based on an average return of 3.5% on invested assets. Although Canada Life, founded in 1847, was the oldest and largest life insurance company in Canada at the turn of the century, Sun Life would surpass it in size in 1908. The life insurance industry was growing as quickly as the banking industry in the early 1900s, though the characteristics of this growth differed significantly. The most notable difference was in the international growth of the life insurance industry. While banks basically did not grow their international business to any great degree, life insurers grew at a remarkable rate outside of Canada. The most notable was Sun Life Assurance Company. It quickly grew to be the largest life insurance in 1908, as I mentioned, by growing aggressively in the emerging growth markets of South America, the Caribbean, and the Far East. Other life insurance companies followed suit, to the extent by 1910, the 6 largest life companies were all operating abroad, and 21% of their total premium income came from outside of Canada. Sun Life had half of its premium income from outside of Canada at that time. Life insurance companies looked to growth outside of Canada principally because the domestic market was too small to sustain the minimal margins between the cost of doing business and retaining the reserves for insured policyholders. Economies of scale could not support the aggressive growth nature of the industry. Intense competition for the relatively small domestic market was forcing the companies to offer innovative new insurance products, such as unconditional policy waiver of premiums on disability, and allowing accumulated paid-up value of insurance to be used against premiums. And these continually ate into the profit margins of the domestic business. And international growth was spurred on by superior margins in these foreign countries, and because of low mortality rates, low cost of living, and hence low commission fees to their agents, and general lack of competition. Other domestic structural developments were also occurring. While the charter banks focused on building a national branch system with head offices in central Canada, the life insurance industry countered with regional and provincial growth through agencies. There was corporate activity at the turn of the century. Examples include the merger between Manufacturers Life at the time, and Temperance and General Life Assurance Company of Toronto. And that combined company became the third largest life insurance company under the name Manufacturers Life Insurance. Crown Life was founded in Regina in 1900. Industrial Life was founded in Quebec City in 1905. Seaboard Life in Vancouver in 1912. Mutual Life Assurance Company moved into its new offices in 1912. Assumption Life was launched in New Brunswick in 1913. Equitable Life and Accident Insurance was founded in Waterloo in 1920. So you can see tremendous activity within the life insurance industry at this particular point in time. As a result of the spectacular growth of the insurance industry, their excess liquidity ensured they could continue to be principal financial institutions investing in long-term capital development of the Canadian economy. They were very efficient at mobilizing savings in the country and investing their excess liquidity in rapidly growing industrial, utility, and transportation sectors. Now, much as the banking sector, the domestic life industry would be tested with the economic recession of 1907, though not necessarily from the investment markets. Rather, it was from regulation, specifically in regulation that was happening in the UK and the US, followed through here in Canada. The federal government's response of scandals in the UK and the US that was revealed in such things as the Armstrong Commission in 1905 was to establish a Royal Commission in 1906 to study investment policies of Canadian life companies. And their conclusion was a concern over the increasing stock component of insurance companies, and that many of these investment positions consisted of conflicts of interest. And we all know the George Cox story, for example, was one example of that, and his financing of the Canadian Northern Railway. A major outcome of the Royal Commission would be the creation of a separate Department of Insurance under the Minister of Finance, and a new Dominion Insurance Company Act in 1910. This increasing regulation came in the context of a rapidly growing industry, but one that was also consolidating. Sun Life acquired Royal Victoria Life and Home Life Association, the Federal Life Insurance Company of Canada, and the Security Life Insurance Company of Canada in 1914. The Prudential Life Insurance Company in 1916, the British Columbia Life Insurance Company in 1917, and the Provincial Life Insurance Company in 1918. So again, tremendous consolidation going in as a result of the increased regulation now that was coming down the pipes. Part of the reason as well for the growth in the industry resulted directly from the Great War and the perception that insurance companies were rather stable places to put your money. A notable change in the insurance industry after the First World War was the rise of the importance of the investment department within the companies. Investment departments became important contributors to overall asset growth of the company and material contributors to earnings growth, and hence we now see this massive growth occurring in the 1920 to 1930 period as a result of investments in stocks. Up to 1900, the majority of an insurance company's investment portfolio was in mortgages and bonds. With the ending of the war, managers forecast drops in yields, which increased the price of the bonds, which were subsequently sold for their capital gains. But insurance companies then began devoting more attention to their portfolios outside of mortgage and bonds and into stocks. At first preferred stocks and then common stocks. The life insurance company's share of total financial assets grew significantly, doubling from 12.5% in 1920 to 26% in 1930, representing a 10% annual growth rate. And this was both domestically and internationally. Sun Life became one of the largest Canadian operating businesses and investors in the United States at this time, and it was the first Canadian company to acquire a U.S. company. Competition ensured continued innovation in the life insurance industry. In 1921, Confederation Life was the first company to introduce a policy that did not require medical examination. And another innovation was the introduction of group insurance in 1919. So several of today's prominent life insurance companies were established during the 1920s as well, so there was still corporate activity going on. Maritime Life was founded in 1922. Empire Life was founded in 1923. It subsequently merged with Kingston-based Commonwealth Life and Accident Insurance Company in 1929. Sun Life acquired Northwestern Life Assurance Company of Winnipeg. They also acquired the Shanghai Life Insurance Company and China Mutual Life Insurance Company, as well as the Cleveland Life Insurance Company, which was the U.S. acquisition that I talked about. The only notable change in regulatory oversight at this time was the amendment of the Insurance Companies Act in 1924, which tried to place some restrictions on stock investments because they were growing to be such a material component of the investment portfolios of the insurance companies. By 1930, Sun Life Assurance Company, the country's largest, had invested half of its investment portfolio in stocks. And that was a recipe for disaster because in late 1929 was the stock market crash. So with the stock market crash, most insurance companies, many of the insurance companies, in particular Sun Life, became insolvent in this country. But because charter banks and brokers were willing to attribute minimum prices to stocks to avoid an industry breakdown through the calling of margin loans, Sun Life and others were able to attribute fictitious prices to their securities holdings. And the Federal Superintendent of Insurance complied with this policy to basically ensure that they were not forced into insolvency. However, the awareness of the solvency, of course, did lead to drastic and abrupt policy changes. And in 1932, the Insurance Companies Act was amended to restrict investment in common stocks to 15% at book value of all the investment portfolios. Sun Life continued to lead the way with investment in business outside of Canada, with 80% of their total insurance premiums coming from outside of Canada in 1930. Similarly, Manufacturers Life was active in 35 countries around the world, and 50% of its company's business came from outside of Canada. But this would mark the peak for international business of Canadian life insurers going forward. The life insurance would benefit from the passage of the new Dominion Housing Act in 1935, because under this act, the federal government pledged its support for lending in housing in an effort to encourage life insurance investment in the construction of new homes. The share of total financial intermediate assets held by life insurance companies, however, now began to decline. Although it went from 26% in 1930 to 27.5% in 1940, we can see now a decline coming through. This growth, the growth itself prior to that was reflected in the growth of bond portfolios now, which grew to 60% of their investment portfolios as equities were diminished. And a lot of that came through the absence of any competition on the mortgage loan business. The insurance companies were the principal providers of mortgage loans at this point in time. The outbreak of war did have an immediate impact on the foreign operations of insurance companies, and hence the peak, as I talked about. And insurance companies subsequently abandoned many small foreign countries that they had been doing business in for many years. They did grow somewhat in aggregate terms, but the share of total financial intermediate assets declined from 27.5% to 19.4% in 1950. After 45, there was again a shift. A part of this was due to the changing nature of the business as well. After 1945, there was a shift outside of whole life premiums and into term life premiums, which were significantly priced lower than whole life. As well, more premiums were to come from annuities and group insurance contracts, with the latter share of business increasing, group insurance increasing from 2% to over 30%, but group premiums are significantly lower than in individual insurance premiums. Insurance companies were active investors in victory bonds. But concerned by the decline in stock investments now and the declining share of market, they introduced the basket clause investments to encourage insurance companies to actually begin taking a bit more risk again, because they now were going to the opposite extreme of being very conservative investors. The issue of foreign ownership of Canada's financial industry now appeared in the 1950s, because they still were cash cows, insurance companies, and considerable interest was expressed by American investors in the Canadian life companies because of their large pool of capital, which appeared to be available at low price based on their stock trading prices. The industry and the federal Diefenbaker government were alarmed at this possibility, and they both agreed that mutualization would be the best option to protect the industry from foreign takeover. So the Insurance Companies Act was amended in 1957 to allow the insurance companies to demutualize. And Canada Life was the first to do that, followed by Sun Life, Manufacturers Life, Confederation Life, and Equitable Life. So they all demutualized and became owned by their policyholders and were no longer publicly traded companies. They also faced a contraction of their market share, in large part because of the growing term, group, and industrial insurance segments of the market, as I mentioned. They tried to invigorate the growth through pension products, accident and sickness insurance, and mortgage insurance, but their market share declined from 47% in 1962 in terms of savings, personal saving assets, to 20% in 1971, and the industry's share of total financial assets declined from 17% in 1962 to 12% in 1970. There would be significant structural change in the 1960s, and throughout the whole financial industry, and the insurance companies would be the biggest loser in terms of this structural change. And the principal reason was due to the obsolescence of their product line. We noted the shift out of whole product into term life and the impact this had on their lower premium revenue. The public was basically willing to buy term insurance, but they weren't looking for insurance for retirement purposes, because the government was increasingly stepping in through pension plans to provide that for them. And the life insurance companies were no longer staffed by entrepreneurs, but rather by accountants and actuaries who were more conservative managers of the business. And again, the basket clause was an attempt to change that notion and make them a little bit more risk acceptable. There were mergers and acquisitions in the companies throughout that period of time. In 1961, the Insurance Companies Act was amended to allow insurance companies to issue segregated funds, which were a type of mutual fund, but with a fixed price, $10, by which was a guaranteed price, by which the value to the individual investor would not go any lower than $10. That was somewhat of a boon to their business short term. Again, lots of mutual mergers and acquisitions in the 1960s. Maritime Life Assured acquired Royal Guardian. Paul Demer acquired Imperial Life Assurance Company in '63. Cooperators Life and Cooperative Fire and Casualty Insurance merged to form Cooperative Insurance. EL Financial Corporation acquired 94% of Empire Life. John Hancock acquired Maritime Life, and Investors Group acquired 51% of Great West Life at this time. The federal government shocked the industry by, for the first time, providing charging an income tax on the life insurance industry. The one sector of the financial industry that was not affected by inflation of the 1970s was the insurance industry. But there still continued to be a lot of merger and acquisition activity. In '77, Power Corporation consolidated its strategy in the financial services industry by firstly selling Imperial Life to Laurentian Group, and then after buying Imperial's stake in Investors Group, and which Investors Group held ownership in Great West Life, as I mentioned, but also Montreal Trust. And Power Group subsequently increased its ownership of Investors Group to 72%. The other transaction to note was the ownership of London Life. The time the Jeffreys ran into private owners ran into problems, and they sold the company to Brascan, as we heard earlier, a company owned by the Bronfmans. Sun Life joined the Royal Bank of Canada at this time, and Bank of Montreal by moving out of the city of Montreal, their head office at this in the late 70s, again out of the independence movement that was going on in Quebec. In 1978, Sam Bellsberg of First City Financial attempted to take over Monarch Life, but was beaten by a competitive offer. So those are some of the transactions that were going on at the time. A period of sharply rising interest rates that occurred in the 1980s should be a boon to insurance companies, because their fixed insurance and annuity payouts are financed by fixed income investments. And any increase in interest rates leverages the latter to a greater degree than the former. There were exceptions to that general rule. Any insurance company exposed to real estate at the time would face serious consequences as interest rates rose. And indeed, this was the case in a couple of scandals and major problems. The first was Crown Life Assurance Company in 1982. It had to be rescued by the Saskatchewan government with an investment because of its heavy real estate exposure. In 1982, Industrial Life Insurance Company of Quebec acquired Northwest Life Assurance Company of Vancouver, and in 1983, North American Life bought Monarch Life Insurance. And then Manulife had to acquire Dominion Life, and subsequently acquired North American Life when its real estate portfolio got into trouble. EL Financial Corporation acquired Montreal Life, and also the life insurance operations of Dominion of Canada Life Insurance Company at this time. The insurance industry expanded into the fast-growing mutual fund marketplace when Sun Life bought MFS Financial Services in Boston. So you can see that the market share dropped significantly. It's stabilized since that period of time. The 2008 financial crisis provided some challenges to the industry, in particular because of, again, the interest rates declined to virtually zero, and that affected their ability to fund their annuity payout business. And so any insurance company with extensive exposure to the annuity business suffered in the 2008 financial crisis. But they have managed to overcome those challenges of the 80s, and they've stabilized. They haven't grown in market share principally because of competition from pension funds, which have taken a significant portion of the market, and the mutual fund industry, which has also taken a significant portion of the industry. In conclusion, the particular challenge going forward is perhaps the fintech, rise of fintech organizations in the industry. In 2015 survey, insurance respondents believe their industry could face a 21% loss of market share to fintechs by the year 2020. So that's the new challenge for the insurance industry. So a lot of history there to cover, but hopefully I've given you a flavor for the history and the excitement that went on in that industry over the last 150 years. Thank you.
Great.